This is Martin from Edge, the channel for learning about trading and investing. Welcome to Markets Next Week, the weekly stock market analysis show, where we look at the charts and try to understand what exactly happened in the previous week, try to learn something from it, and plan for a better trade for the upcoming week that's starting from tomorrow, November 20th, Monday 2023. If you're not subscribed, please subscribe right away and straight to your friends and colleagues. It reaches out the maximum. Thanks for watching. So here, let's get in the charts. Weekly view. This is showing that we are still in the midst of a rally. We had a cup and handle breakout. We had multiple flag breakouts, and we are on the way up. Banknifty also, we have rounding cup and handle pattern breakouts and multiple flags, and we are moving up, but in a slower pace as compared to Nifty. This is another weekly view. We are still in a trend line. We had hit the resistance. Both indices had hit the resistance and then pull back, and then now it's in the process of moving up. Yeah, well within a trend line parallel channel. This is for the daily view. Right, market has been trending up. It retraced in the August. Then it moved up, made all-time highs, retraced a little more, next retracement, but reversed, and we are on the way up, right? And daily charts, this is daily view. Daily view also indicates that we had a big breakout attempt on both indices, a failed attempt, and reversal on the Banknifty. Both seen on stage. We'll see that later. Let's see the candlestick patterns on the weekly. So at the left side you have the Nifty weekly chart, weekly candlestick, which is absolute bullish, wide range bullish candle. Right side you have the Banknifty, which is a bull trap. It went above the previous candle's high and hit resistance, reversed and trapped all the bulls, and then closed below the previous candle's close. Right, so the bull trap and an inverted hammer. An inverted hammer does not have much relevance unless it's in the top of a trend. If it's in the top of the trend, it couldn't get reversed. But even here also, if you consider this as some kind of top, reversal would be confirmed if the price moves below the candle's low. Right. So a bearish candle on the Nifty contradicting to a bullish candle on the Bank. Bearish candle on the Banknifty contradicting to a bullish candle on the Nifty. That's what we are. Candlestick patterns are bullish and bearish accordingly. But it's even more bearish with the bull trap as seen on. Bull trap could lead to more reversal. Bull trap along with bearish, in kind of inverted handle makes it even more bearish. So Banknifty is definitely bearish on a week-to-week basis, and Nifty is absolutely made it in the bullishness. Now the daily candlesticks, very interesting. Look at this, what has happened. Strong week of 4 days. Previous week we had on Thursday you had a gap up, then you have a gap down, then you have a gap up, then we are consolidating Nifty. But look at Banknifty, you had a gap up, gap down, gap up again, gap down big. So it's absolutely volatile. Remember, the VIX is still in the low volatile regime of less than 12. So within the low volatile regime, the intraday or daily volatility is too much, too difficult to handle when it comes to derivative traders, especially. Right, market does not give direction properly when it comes to Banknifty, especially. But regardless, you can see that it had broken out of the trend line, joining the ATM and the previous swing highs, and price action wise lower low, lower high is taken out. But it is not taken out on Banknifty, and we had met with resistance exactly where we were closer to that price action lower low, lower high. So that's a daily candles. It's an inverted hammer, which may not have much relevance when it comes to the implications of the candlestick, but it's red inverted hammer and green kind of inverted hammer, and also an inside bar within the previous one, indicates some consolidation of the Nifty. So right, and also making note that this is a change in priority zone. This is a resistance zone from where the market broke out. that could actually support now and could consolidate here and then also give a bounce to the upside. So that's positive, shown on the candlesticks. Look, this Bollinger Bands, it's still not bearish expanding downside. It's still not that. It is still above, the price is much above the 20 moving average, which is the median of the Bollinger Bands. So Bollinger Bands are indicating a bullish biased consolidation, both indexes, even the Banknifty. It is consolidation only. It is not expansion yet. So Bollinger Bands daily, right? Bollinger Bands are indicating in the short term it is still consolidating. Let's before getting this, looking at the support resistance levels, let's just wrap up the numbers. So we have a Nifty that closed 1% up, 207%, and we have a Banknifty which closed nearly 1% down, 417 points. That's what has happened. So white range bullish candle. Here we have a bull trap hammer bearish candlestick. And remember, we had Nifty had record near 4.8%. That's 900 points of record. But Banknifty trying to do that, but after the earlier 9% correction, it met with the resistance at 44,400, so 500 zones, and then reversed and nosedive on a Friday. So it's closed below the 20 weekly expansion moving average, but Nifty closed above the 20 expansion moving average. Remember, more than as still in a rally of 20% from the cup and handle and flag and all that breakouts that we have seen earlier. So the daily time frames both ended negative on Friday. It's flattish negative and a little more negative of 578 points, nosediving on Banknifty 1.31. So overall, each day if you analyze, it was up and down, gap ups and gap downs, and highly volatile moves. And finally, Banknifty was closing below the 20 exponential moving average, below the 50 and below the 100. So that suddenly it has turned bearish. So the question is whether this attempt of Nifty to break out almost succeeded, you can say, except the gap that is set immediately at 878. There is a gap, window gap. So whether it will clear that or not is a question. Bollinger Bands absolutely shows that it's consolidation only. So let's look at the support resistance. The first resistance for the Nifty would be the gap 18. It's 19. The gap is at 19,878, I believe. It went inches above that. Right? So this gap is the first resistance. And then above that you have 19,990. That's rounding numbers coming. The 20,000 will be a good resistance. Above that 20,115 has got a gap resistance, and then 20,222 all-time high resistance. Downside supports could be found at 6. The first resistance before this gap resistance would be the previous swing high at 19,737. So maintaining the 9,700 is also important. So there will be a support also. So then I have 9650, 19,600, and in 500 is a very good support. Right? It's a gap also at the 19,500 zones. Then 19,476. 19,465 would be a 20 moving average support. Then 19,300, 19,275 has got a gap support. 19,175 again has got another gap support. So these are all good supports downside. So 90,000 again can be a rounding number support. Then it goes to the 200 moving average, which comes along with the gap support at 18,800 at South Nifty's. Banknifty maintaining the climbing above the 44 is the first task, right? That will also mean climbing above the 50 and 100 that it has lost expansion moving averages. So 44,000 clearing is very important. There is a gap that is formed because of the nosedive that happened on Friday. So that's coming at 4,400 nearby, so on 4,464. So 44,000 is very crucial to be made, and 44,200, then 44,400, 44,768, 44,949, and 45,100. That's where the previous swing high will be cleared. That's the resistance in the upside. And the downside, you can see that the first will be the maintain the 44. So if that's now it's already breached that and 400. So 43,600. Maintaining that is a 20 moving average that's coming at 43,695. It's lost that. Climbing above that will be the first hurdle. Second hurdle will only be 44,000. So 43,600 will be support. 43,500. 350 would be a support. That's 20 moving average. That's very crucial. So 43,500 356, it's a 200 moving average. If that is breached, we have trouble, right? 43, 283 is a swing low. So if that is also breached, then we can head to 42,000. So real big trouble. So keep a close watch of 43, 350 downside of the bank nifty. Let's look at momentum and the trend. So weekly Nifty and Bank Nifty is what you see on the left, and daily is what you see on the right. So you can clearly see there's a rising momentum in the Nifty on the sideways and rising. Bank Nifty sideways and falling on the weekly, on the daily, bullish falling on Nifty and sideways falling on the Bank Nifty. So that's what the momentum is, right? So there is bullishness in the Bank Nifty, bullishness in the Nifty, and it's a sideways in the Bank Nifty overall, right? And the trend indicator radius shows a bullishness on both indices on the weekly time frames, but it's bearish definitely on the Bank Nifty, while Nifty maintains the bullish trend, right? So that's a summary of how the trend of the momentum is playing. So overall, we can say momentum is it's opposite of between two indices, and trend is also opposite. Right? It is lagging behind with respect to trend and momentum both. Volatility analysis, what we do along with the open interest. India week's volatility indicator or greater than indicator has spiked up 6% more last week. After a long time, it is now 11.83, but still below 12. It's still very much in the low volatility regime, although we had a very, very volatile price moves that happened in each individual days. The gap downs and gap ups and all that caused spike in the VIX as well, but finally it ended up just 6% up, despite the fact that we had a breakout. VIX was supposed to have cooled off when the week-to-week basis. It should have cooled off actually, since the market has moved up 1%, especially the Nifty index. So that's not reflecting this. So that's probably an indication that the move up may not sustain, right, as the VIX may indicate probably, right? So I'll keep slight cautiousness. We'll read some cautiousness from the movement of the VIX, but it was very, very volatile week. Now, open interest analysis, if you see the Nifty is showing long unwinding bearish, and Bank Nifty showing short build up bearish. Futures open interest is what we're talking about. Now, for the options open interest of November 22nd and 23rd, 22nd is Bank Nifty, 23rd is Nifty. It's showing that the board call ratio is not bullish enough, and in fact it's bearish on the Bank Nifty. So open interest is not in favor of the bulls. VIX is also cautioning a little bit. Moment when trend is contrasting, Bank Nifty is lagging behind, is weak. And if you look at the open interest data, you can see that heavy resistances are built up, and that's dominating. Look at the range. The highest support is seen at 9,700 and 9,800 is where the highest resistance is there in Nifty. Very tight range, 9,700, 800. But look at the range of Bank Nifty, 42,000 and 46,000. Option riders are seeing that very wide swing moves can happen. Anything can happen on the Bank Nifty. But Nifty, the option riders, as of now, we still have many days, 4 or 5 days before the weekly expiry is on 23rd. But this is what the option riders are seeing as of today. So options, tight range Nifty, wide range on Bank Nifty, put call ratios not bullish, and in fact bearish. Futures OI also it's having bearish build-up that's happening. So options OI is bearish, right? Even for the Nifty, it's not bullish enough, I would say, right? Now here's the interesting part. It's the sectors, different indices sectors, how it's performed. So we have now, for out of the 6 or 7 major sectors that we're analyzing, we just have 2 sectors that's not completely bullish. You can see that we have leaders in the sector that's driving the market. The reality, FMCG, pharma, auto, all of these have absolutely moved in the bullish zones in the 4 time frames of weekly. And look at the move. The auto sector 4% near breakout. Reality 4.6% breakout. Pharma 2% breakout. 1% FMCG breakout. IT 4% up. Metal 2.3%. It was across the sector bullish moves that you have seen, but IT and the metal has to catch up some more before we can say both the weekly and the daily. So it's time to take long bets on that sector, pharma, FMCG, reality, since that's what the momentum indicator is in the short term and the medium term is telling us. Let's look at the charts. ID sector of the index, the sectoral indices is what you're seeing here in the screen. ID index is showing that it's sideways rising up, right? Metal also sideways rising up, right, reaching the bull zones. But look at auto. It's a bullish momentum divergence, and it is absolutely paid out after hitting the RSI 40 and then bouncing up from there, breaking out all-time highs on the auto. Pharma breaking out all-time highs. Absolute bullish momentum divergence playing out and bouncing up. FMCG heading towards all-time high once again, climbed back in the bull zones, turning bullish. Absolutely. Reality, look at that all-time high, multiple divergence, bounds up some momentum bullish divergence, and absolute 3 weeks candles. Look at the gigantic moves on the reality and the big breakout moves on the pharma and the auto that is happening. So we have four sector leaders who have emerged, and then that could probably a big plus. That's what is holding the market up there. It's just the Banknifty that's lagging behind. Look at the indices. Nifty Bank, the major contributor to the index, has climbed just into the sideways zones, right, with some green tick there, but yeah, at least it recovered from the bear zones that closed last week. Reliance Industries, another major stock that's contributed maximum to the index, is also in the sideways and rising. ICICI Bank also is in the sideways, but it's taking a slightly bit weak. Infosys is showing that it's a wide range bullish candle, bold range bullish candles, and moment is rising up in the sideways. And Kodak Bank, as usual, showing some green, but it's in the sideways as usual. And some green tick is seen with the sideways up move attempt by the ITC. That's what you're seeing. So if you see, it's all the major. See, this is the sad part, right? This is the sad part. Across a sector move up we have seen that, but the heavy weights. Look at that. We don't have a clear leader yet. We don't have a clear leader among the major indices. That's holding up the indices, right? We have none of them in bullish moment. So this is where the selling had been happening for all these 17-18 weeks in the Fyers, except for this week. This is where the selling has been. So it's still weak, heavyweight stocks. Is what you're seeing, right? You're seeing green tick in Kodak Bank. You're seeing big green tick in IT, Infi and TCS, and you're seeing tick in Reliance also and HDFC also, but still not enough. The momentum is still sideways for all the major sectors. So it's the other sectors that's getting bought. So that's a kind of concern, something that you have to be cautious and know about. Now here is good news. Finally, the Fyers have started net buyers. Started buying after 17 or 18 weeks of consecutive selling. The first week we are seeing a 200 or very small, but the green has finally emerged in the market after a very, very long time. It's very positive. There's also a buying, so naturally it was a green week after a very, very long time with the buyers coming back as buyers, not selling at least. Derivative side also moves flat from the FI point of view, so that's something positive. Let's now analyze the global markets, currencies, and global commodities, etc. So starting with the currency, the dollar index is cooled off 2% nearly. It's around 3.8, which is good, right? And what was it to the sideways and falling down. So USD INR is closed flat, slightly down 83.33. So despite the dollar falling down, nothing much has happened. The rupee remain to be weak with sideways falling momentum. Remains to be the weakest. So that's what you're seeing. You can see that it's a descending wedge, and it has been there since years now, very, very long time, and it's absolutely neither breaking out nor falling down. It's absolutely in the narrow ascending wedge, and it's just because of the RBI intervention that the price is being held there. Dollar index, after the Fed inflation cool off news that came in, dollar index has cooled off with a wide range bearish candle, but still the moment when sideways and falling, and then it's a neckline. It will take us about here and consolidate at this 100 nearby levels, 100 and 200 levels. Now here comes the crude oil, another cool off. It's fallen to 76, right? So crude has fallen nearly 2%, 1.7%, momentum sideways. Remember, we had a 50% of fall. 50% of a move up had happened earlier, which took it to the 94 levels, and then it has cooled off. Right, that's good. Gold also had fallen last 2 weeks. Now this week, for some reason, it is once again climbing back and trying to hit that. After the war news cooled off a little bit, gold had cooled off last week. But this week, we're seeing a spike again. As a hedging instrument, it's good. Good if the market is correcting. So that's it. A cool off in crude and US dollar. European mining weak. US, yeah, will not come to the, and dollar index is, yeah, so will not come to the last part. So that's global markets. Dow Jones green. Look at this, 3 weeks. It's 8 to 10% of move that's across all the major indices in the US. Dow Jones is moved up nearly 2%, Nasdaq 2%, S&P 500 2%, all having momentum that's rising up and heading towards the bull zones. And trend is getting crossed over. So this is the reason why the market is moving up. This is following the Fed news, the inflation news that came up. Right, Fed non-hawkish news before that, and all this created the US markets to rally for the last 3 weeks, and it's still heading towards, and it's still not made the all-time high. It's 37,000 here. It has to go a long way to go there. It's still in the top of a descending wedge. All 3 indices shows that. So US markets are green, which is very positive. Crude has fallen, good expect for some of the oil marketing companies, and dollar is cool off a little bit, although rupee shows some flat down move, remains weak. Yeah, so some positive news there from the global commodities and currencies, and and the US major mother market indices. Right, let's come to the actionables for the next week. Here comes anxiety interest in the auto sector, how it is blocking out. We have seen at all-time high levels, and here we have a good risk-reward trade that can be attempted because it's a cup and a rounding pattern breakout that could potentially move up to give a risk-reward of 1:1.5. Oil is rising up above the RSI 60, and the trend is also bullish. Volumes are decent enough. So anxiety industries could be a good bet for swing trade opportunities. Cipla, pharma sector is also breaking out. It's in a wedge. It could move up to the top of that wedge top, or break out from that as well. Because the momentum is bullish and the trend is bullish. Volumes are decent. And have tight stop loss in both, because market has some problem with the banks. So be slightly cautious, but yeah, tight stop loss and take the bets for swing trade opportunities on both of this, Exide and Cipla. Or Exide contributed to the auto, Cipla pharmaceutical sector. Let's take the next actionable. That's a weekly option strategy on the Nifty, where we are selling double diagonal current spread. That's we're selling 19,500 put. That's OTM put and OTM call. We are selling 9900, 9500, right? And then we are taking head positions for the week that's after that, the far week, right? And we have a very good, decent risk reward if you are exiting early before the expiry, and very good range. That's the beauty of this double diagonal current spread. I mean, 400 to 20,000. It's a very reasonable, good range that we're getting, and this is giving us margin benefits, and we just have to spend more, probably 1 lakh less every lot positions as per your capacity of and risk appetite, right? So that's risk defined, and you'll completely know what you lose max. You can also do the adjustments in case it breaches, but very wide range and reasonable pop and risk reward is what the benefit of this, right? That's actionable for the next week on the options Nifty strategy. Let's just wind up after having done all these studies and come out with actions and all that. Let's see what exactly happened. So it was another attempted breakout, another attempt to reverse, third week consecutively. So absolutely good move from the market point of view, but the practice, Banknifty in that attempt failed and went volatile, and then come back to support zones, reversed. That's what happened. So basically we're still consolidating as with the bonds bands. So we had correction, some 79% of correction had happened. We recovered half of that, and then Banknifty is not very enthusiastic about it. But remember, we are about in a rally of 20% up. cup and handle breakout. That's what we are, and we're basically consolidating. That's it. So the green news market for the last 3 weeks, fast trending buyers after a very long time. Crude oil and the dollar index cool off. The momentum and the trend indicators of the index is climbing up. Which is still in the raw regime. Across sector, big breakout moves as we have seen. All of this is for the bulls to think that it may be consolidating before it makes the next leg up. It may further move up. It's all bulls can hope. But the Banknifty is weak price action. The trend and the momentum, all of this, along with the lows that happened in the Banknifty last week. A non-bullish OI and food correlation as seen on both indices. Long unwinding and short build-up positions for the futures OI. Bollinger Band showing consolidation and not an expansion on the upside. All this give hope for the bears that we could expect more fall. So basically, market, as you've seen, is attempted to break out. Question is, will it, with this weak Banknifty, will it happen? Are we getting for more fall, or are we going to consolidate some more time so before deciding that, or are we going to catch up once the banks also catch? So are we going to further move up? So that's a $1,000,000 question. But I would like to conclude that it's a mild bullish and neutral view given the cross moves and several other factors that it's traded. I would take a market view of mild bullish to neutral view for the next week. The global cues and Russian fears, inflation, interest rate war, and all things are still there. So, black swans will come in any time. So we have to be completely hedged and cautious. Still, the trend is not absolutely clear. 19,220,000 may be the levels for the Nifty in the next week, and 43,500 and 44,000 may be left for the Banknifty in the next week. So it's mainly in this 90,000 and 44,000 till the elections is very important, so that we can hope for a continuation of the rally or breakout. Right. The market may be consolidating, is what looks like. So net risk should not be taken because we are having state elections, we are having uncertainties and global uncertainties, and we have the charts which is telling it be cautious, trend is yet to be clear, things like that. So always have hedge positions, and every time, even if it is falling, try to invest in quality stocks in SIP mode, and then and play on that. And it is for less than 1% of something, 1% or less, or more, slightly more. That's all we need from the trading point of view. Investing point of view, every dip may be an opportunity to buy. So that's all for the week. So if you're watching this and do not subscribe, please subscribe and share to friends and colleagues so that it reaches out more. We would like to hear from you on the comments, and share to friends and colleagues, please. And we also have good presence in the social media where we are posting technical analysis on a daily basis, apart from this weekly videos that we publish on the YouTube. So don't miss out on that. Subscribe to this and then share to your friends and colleagues. That's all. Thanks for watching. Happy trading, happy learning, happy investing. Bye bye.